The S&P 500 is up 28% year to date. But what if this bull market is actually a dangerous illusion? Today we're diving into the psychology of market momentum and why the current environment might be more perilous than it appears. Hi, I'm Jeff Robinson. I lead the investmentanalyst.com and host our podcast, Unlocking the Upside. Today, I'm joined by James, my co-host and former buy-side analyst.
Hi, everybody. And wow, that's a bold statement to kick things off. What's got you thinking along those lines?
Well, it's a combination of factors that are creating a perfect storm of market psychology. Let's start with the bandwagon effect. When markets trend strongly in one direction, we see a cascade of psychological biases kick in. The first is confirmation bias. Investors start seeking out information that confirms their bullish stance while discounting contrary evidence.
That sounds like it could lead to some pretty skewed decision making. Are we seeing any concrete examples of this in action?
Absolutely. Asset managers are currently holding their highest net long exposure to the S&P 500 in more than 2 decades. This isn't just about optimism, it's about the powerful psychological pull of consensus thinking. But here's where it gets really interesting: the self-reinforcing nature of market momentum.
Oh, you mean like a feedback loop? How does that play out in the current market?
Exactly. As prices rise, investors experience what behavioral economists call recency bias, the tendency to overweight recent events in our decision making. This creates a feedback loop. Rising prices attract more buyers, which leads to further price increases, reinforcing the belief that the trend will continue.
That sounds like it could get out of hand pretty quickly. Are there any technical factors at play here too?
Absolutely. We're seeing 3 critical technical factors converge. First, market breadth has improved significantly, with leadership rotating into cyclicals and small caps. This typically signals a healthy market expansion. However, when we dig deeper, we find that this broadening came only after an unprecedented concentration in mega cap tech stocks.
So it's not as rosy as it first appears. What are the other factors?
Well, the second factor is the liquidity environment, which is extraordinarily accommodative right now. November saw a record $144 billion flow into passive US equity index tracking funds. This massive influx of passive money creates what I call the autopilot market, where fundamental analysis takes a backseat to pure momentum.
That's a staggering amount of money. And the third factor?
The third is a dramatic compression in the VIX, now at 12.8 versus its long-term average of 20. This leads us to another fascinating behavioral concept, the stability breeds instability paradox, first proposed by economist Hyman Minsky.
Oh, that sounds ominous. Can you break that down for us?
Sure. Minsky argued that periods of stability encourage greater risk-taking, which ultimately leads to instability. We're seeing classic signs of this theory in action. The put-to-call ratio has fallen below average, indicating investors are less interested in downside protection, and retail investor enthusiasm is at a 37-year high, according to Conference Board surveys. Okay, James, can you let me step out of our chat for a moment? I'm keen to talk about the app. Throughout my decades on Wall Street as a top-ranked analyst, including being named number 1 by Institutional Investor 10 times, I've gained deep insights into markets and investing. But what truly energizes me is sharing this expertise with individual investors like you. That's why I created Insight One, a revolutionary investment education platform that combines my extensive market knowledge with cutting-edge technology. We've taken the sophisticated analysis I've provided to major financial institutions and made it accessible right from your mobile device. For those of you who value the market insights from this podcast and want to take your investment knowledge further, Insight One is your next step. You can download our app from the App Store or Google Play, or visit us at theinvestmentanalyst.com. Now let's return to our discussion.
Wow, those are some pretty clear warning signs. Is there anything else that stands out to you?
Yes, and this is particularly striking. The momentum factor outperformance has only been this extreme twice in 70 years, during the 1999 tech bubble and the 2021 meme stock mania.
Those are 2 pretty notable periods in market history. Should we be worried about a potential bubble forming?
It's definitely something to be aware of, but Here's where it gets really interesting. Despite all this technical strength and investor enthusiasm, corporate fundamentals tell a different story. The market's forward PE ratio has expanded even as interest rates remain elevated. That's a historical anomaly that challenges traditional valuation frameworks.
That does sound concerning. Can you break down the earnings picture for us?
Sure. On the surface, aggregate earnings growth looks decent at 8% annualized. But if you strip out the largest tech companies, that number gets cut in half. This divergence between market performance and underlying business performance is precisely what behavioral economists would flag as a warning sign.
So how should investors navigate this kind of environment? It seems like there are a lot of potential pitfalls.
Well, there's no one-size-fits-all answer, but I can offer a framework for risk management. First, review and potentially reduce oversized positions, especially in recent market leaders. Second, consider sector rotation. Look for opportunities in less crowded sectors, particularly those with strong fundamental support.
Those sound like solid strategies. Any other advice for our listeners?
Absolutely. Diversification is key, perhaps now more than ever. Look beyond traditional stock bond allocations to include real assets and alternative investments. This can help protect your portfolio if we do see a significant market shift.
I can't help but wonder, with everyone seemingly on the same page about the market, doesn't that create opportunities for contrarian investors?
That's an excellent point. The very uniformity of current market opinion does indeed create opportunities for contrarians. When everyone is positioned the same way, the potential for surprise increases dramatically. It's fascinating how the market can create these situations where the most comfortable position might actually be the riskiest.
It reminds me of that famous Warren Buffett quote about being fearful when others are greedy and greedy when others are fearful. Is that the kind of thinking you're suggesting?
Exactly. Buffett's wisdom encapsulates the contrarian mindset perfectly, but it's important to note that being contrarian for the sake of being contrarian isn't enough. You need to have a solid rationale based on fundamentals and a clear understanding of market psychology.
So how can our listeners develop that kind of understanding? It seems like there's a lot to keep track of.
It really comes down to continuous learning and staying informed. Keep an eye on both the hard data, things like earnings reports, economic indicators, and technical analysis, and the softer psychological factors we've been discussing. Pay attention to sentiment indicators, watch for signs of excessive optimism or pessimism, and always be willing to question your own assumptions.
That's a lot to take in. Do you have any specific resources you'd recommend for listeners who want to dive deeper into these topics?
Absolutely. For behavioral economics, I'd recommend starting with Daniel Kahneman's Thinking Fast and Slow. It's a fantastic introduction to the cognitive biases that influence our decision-making. For market analysis, I'm a big fan of Howard Marks' memos. They offer great insights into market cycles and investor psychology.
Those sound like great resources. As we wrap up, what's the key takeaway you want our listeners to remember from today's discussion?
I think the key is to remain vigilant and analytical. The convergence of behavioral biases, technical strength, and fundamental disconnects creates a fascinating market environment. While momentum can persist longer than many expect, history teaches us that periods of extreme consensus often precede significant market transitions. Always be aware of the psychological factors at play in the market. It's not just about numbers and charts. Understanding human behavior is crucial to navigating these complex waters.
Well said. It's clear that successful investing requires a blend of quantitative analysis and psychological insight. Any final thoughts before we sign off?
Just a reminder to our listeners, keep questioning, keep analyzing, and always be aware of the psychological factors at play in the market. As the saying goes, the most crowded trades often feel the most comfortable right until they don't. Stay curious, stay skeptical, and remember that in the world of investing, sometimes the most valuable skill is the ability to question your own assumptions.
That's excellent advice. I think we've given our listeners a lot to think about today. Thanks for this fascinating deep dive into the psychology of market momentum.
It's been a pleasure as always. Until next time, keep your eyes open and your mind sharp. The markets never sleep, and neither should your curiosity. Remember, in times like these, it's not just about riding the wave, it's about understanding the currents beneath the surface.